This video entitled Bubbles Putting Market on Verge of a Crash, which was originally produced just prior to Mr. Trump's surprise election, is in the process of being updated. Due to the extreme recent volatility and most of the bubbles still being intact, we are making the 2016 version available while the video is being updated. Take a look at this 15-year 2003 to 2018 chart which compares the prices of stocks and long-term bonds. When the stock market peaked in 2008, the spread between stocks and bonds, as depicted by the gold vertical broken line, was at its widest since 2003. The result was the spread closing or the stock market crashing down to the price level the bonds were at, as depicted by the yellow circle. The same thing happened for these three peaks. Due to the spread being very wide in 2016, had Mr. Trump not been elected, stocks would have likely crashed to the level of the bond market. Instead, after Mr. Trump was elected, the spread between stocks and bonds widened to an extremely dangerous level in early 2018.
Market bubble number 1. On Friday, July 8, 2016, long-term U.S. Treasury bonds hit an all-time high and the S&P 500 hit a 52-week high. Subsequently, the S&P 500 hit its all-time high the following day on Monday, July 11. This marked the first time in history that both bonds and stocks simultaneously traded at all-time highs. Market bubble number 2. This chart depicts the price histories for the long-term bond and stock markets from 2006 to 2016. Historically, bonds have gone to new highs when stocks hit new lows and vice versa. This is a good example of the inverse relationship that bonds and stocks had prior to just recently. After Lehman went bankrupt, the bonds appreciated by 28% to new highs, while the S&P 500 declined by 38% to new lows. Here is the vice versa of the example that was just shown. After the stocks bottomed, the bonds peaked. Then, the bonds declined by 25% while stocks appreciated by 40%. Since 2014, which is when negative rates were first introduced, bonds and stocks have been trending up together. This new trend is extremely disturbing. This bar chart underscores why bonds are the crucial safety net for stocks, which is now missing. For every year that the stock market has gone down since 1929, the bond market has offset the losses for investors by producing profits. Now that bonds are going up with stocks, the mechanism or safety net of investors selling bonds at tops to buy stocks at bottoms and vice versa is no longer in place. Market bubble number 3. This chart depicts the long-term bond prices versus the bonds' yields from 2006 to 2016. The relationship between the two is exactly inverse as it should be. When the bond's price hit an all-time high on July 8, its yield was at its all-time low of 2.2% on the same day. This is the same chart with the S&P 500's price history added on to it. Notice that on the left-hand side of the chart, the S&P 500 mimics the bond yield. It's only logical that when bond yields go down, that stocks should sell off since the underlying bonds are appreciating. Remember, throughout history, bond prices and stock prices always had an inverse relationship. Based on what happened on the right side of the chart, the S&P 500 is now behaving as bonds instead of stocks. In addition, for the first time ever, the yield on the long-term Treasury bonds fell to below the dividend yield of the S&P 500. Market bubble number 4. Not only is the S&P 500 trading at a premium to the low-price stocks index, but the current divergence between the two indices is the widest ever recorded. This is indicating that the S&P 500 is extremely overvalued, while the low-price shares index is extremely undervalued.
We highly recommend that you watch the video, Profit from the Coming Crash. It also provides details about the 90-10 liquid asset crash protection strategy. The 90-10 is the only fail-safe solution that protects your assets from crashes, recessions, and depressions. Scroll down below for access and click the button to receive a link to the video.